and none other than Blake Young, who will be broadcasting live from, well, Utah, specifically where? The greater Salt Lake area, if you're interested over here. By the way, yeah, Captain Kirk is here. Sweet. Um, yeah, you know what, Chad and where you guys might be joining us from tonight? Get a little bit of a rolling start before I officially kind of introduce Blake. It's a strange hour. Everybody's kind of hopping on right now. Actually, the numbers are jumping on here as we get off and rolling. So sit down, tune in. It's kind of weird. I had to put a lot of lighting on tonight just to be able to. There we go. The lighting's a little bit lower now. I can see what's going on. It was blinding, I tell you, blinding. So cool. One of the reasons we actually do the session at night here is we really and literally have people joining us from all over the world. Like somebody just chatted in Poland, Wisconsin, go Packers. Seriously, man, it's not even football season. Like we're starting to turn the corner and think about it, but you just calm down over there, okay? Michigan, all right. You know what? At least you have a football team. Michigan does, at least now. It's good. There's a couple people in here from Michigan. Cool. So yes, there is sound. I love when people ask about sound. There is sound. So sit back, relax. We'll get streaming over here. Current markets have been interesting, which I'm going to talk about momentarily. Oh, cool. Oh man, people are joining us from all over the place. Okay. Uh, Florida, we got Texas. All right. All right. New Yorkers. Nice. Um, New Yorkers. How's that working for you? All right, Cincinnati, sweet. By the way, I absolutely, no matter how many years I've actually done this, I love actually knowing where everybody's from, and especially when people are coming in from around the world. It's very, very cool. And by the way, if you see me looking down, I'm reading your chat over here. You can talk to Blake up here. I've got the screen I'm broadcasting right in front of you. I'm actually going to bring up my trading application. You know what? To kind of start before I officially introduce Blake, this is wild what we're looking at on the screen right now. Just again, just a brief kind of thought in the markets, and it's kind of a rarity that I get to kind of discuss this, introduce Blake over here. But what you're looking at right now is one of the single largest divergences of major index products. And the reason I wanted to show this before I introduce Blake, it's actually going to fit very nicely into precisely what Blake is going to be discussing this evening, which is, of course, deep currents. And he's going to get more into that in just a few minutes. But what you're actually looking at, and again, it's kind of weird because you know what, people don't typically get to see a chart that looks like this, where you're starting to plot, for instance, multiple underlyings. But I thought this is kind of cool. Right there, okay, happens to be none other than it's the S&P 500. I represented it as the spiders. Okay, right here is actually Dow, and you can talk about it till you're pretty much blue in the face, right? It's Dow. This is Dow versus S&P. The reason that I am bringing it up in this manner, they are literally completely and utterly split. And then to further it, and that's the S&P versus the Dow. To further it, I'm going to bring up the Nasdaq, okay? And it's the Nasdaq versus Dow. Look how wild this is. And up top here, to represent Nasdaq, this is the QQQ, which is the Nasdaq 100, and this happens to be Dow. Now, look, I'm not here to be a big proponent of the Dow at all, but one of the craziest things that you can pick up on in markets is divergences of this magnitude. Okay, and this is a conversation. You're like, oh, how can I take advantage of this? Again, that's exactly what Blake is going to explain in some more depth here this evening, discussing some deep currents. But such a cool thing to take a look at in other trading. One of the other aspects that really resonates, especially today, is how wild, for instance, US dollar has been. There has been dramatic news about US dollar, and hopefully we get to that. If not today, we'll get to it in the near future here. But dramatic news, of course, about US dollar, but the volatility inside of the dollar is near record breaking. If you haven't looked at that before, it's well worth looking. And the other aspect is major sectors like the XLF, which are the financials, okay, diverging straight down, okay. The energy sector, if you haven't looked at the energy sector, diverging straight down. If this were, bear with me on this thought, if this were even 2 or 3 years ago, if you saw the financials down this much, if you saw the energy sector down this much, it would have taken the entire S&P 500 along with it. And that's one of the reasons I wanted to kick it off with just a brief discussion about some of the divergences. And that's a theme that you're going to be hearing a lot of in trade coming up. The divergences in here are just phenomenally large, to the point where they're effectively record breaking at this point. So with that, I wanted to start with that. Just a little quick market talk over here as we kind of bridge our way into deep currents. So in just a moment, we're going to be bringing on none other than Blake Young, which I'll talk about here momentarily. Again, my name is Don Kaufman. You are watching Deep Currents. It's the new secret to a prosperous retirement. Again, in a moment, I will introduce Blake Young. This is a risk disclosure. We are not financial advisors nor a broker dealer. One of the reasons we pull that up here at TheoTrade is myself, Blake Young specifically, okay? Blake and I originally met at a what was, well, a fairly small startup firm called Thinkorswim. And both of us actually, we spent the better part of about 15 years working together before we even had launched TheoTrade. So kind of instrumental, but one of the nicest things to discuss right now is we're not financial advisors. We're not for a broker dealer. Okay. We have broken free of the regulation and it is sweet. It's copyright disclaimer. This is ours. This is not yours. Okay. Look, the real reason I throw up the copyright disclaimer is right here. Okay. Support at theotrade.com. One thing I think it's critical. It's instrumental to know about us here at TheoTrade. Okay. You can email us anytime. And please, I suggest you do. Has anybody here ever emailed us from time to time? Anybody ever emailed us from time to time? Just go to support at theotrade.com. So we use a common inbox, and it's fantastic. In fact, if you put like Blake Young in the subject matter, or go directly to Blake, you put Don Kaufman in the subject matter, it goes to me. Okay, it's important. I want people to know that you can email us, and yes, I answer email. Yes, Blake Young answers email. With that being said, well, I'm going to start to introduce, okay, the one, the only Blake Young. All right, so a little bit about the background. So Blake Young has been in this industry just about the exact same time I have, which is I started actually in the late 90s. Blake started just about the exact same time, kind of came up through some of the ranks together. In fact, Blake, back in the Thinkorswim days, worked side by side with me in the same group in the education side of things. And at one point, as Thinkorswim is a small firm, it's a startup firm, at one point, we were managing the education for what was 7 million retail clients at TD Ameritrade. Both of us made our exit when exiting was good, but Blake has got trading, Forex and futures for over 20 years. He's also been a principal commodity trading advisor. A lot of people hear the term CTA, have no idea what it is. It's commodity trading advisor. Okay, it's a registered rep, similar to like a stockbroker, but it would be on the commodity trading side of things. He's also a hedge fund manager. He was a senior currency analyst and financial market instructor for 24 years. Of course, that was working side by side with myself and many of us here at TheoTrade. He's created dozens of educational courses. Okay, I mean, some of the offerings both at Thinkorswim and TD Ameritrade over the years, I mean, literally instructing thousands and thousands of people, okay, in both live events and of course online. And I love this because Blake's famous saying, I would rather miss a good trade than take a bad trade. And I love it. So ladies and gentlemen, I want to turn it over to none other than Blake Young. Blake, you are welcome. Blake is taking the main stage right now. Here he goes. So welcome, Blake.
All right. I just need to be able to share, and I'll share this right where we're going. It's appreciate it, Don. Don and I really have. I mean, we did a lot of road trips, and if you want to get to know someone, in my personal opinion, is run a 12-hour day on your feet and then try to unwind at the end of the day. And I think you really get some real experience knowing the people. And so I appreciate Don and all the things I've learned from him as well over these years. Um, yeah,
Hopefully they can
just
enable your screen share over here in just a second.
yeah,
We'll get you up and
yeah. We'll get
going.
me there. We'll get us
Yeah.
there. So, some of the people did, that have asked if this presentation is similar to what we did last week, and it's part of this, like Don already said, is this is about giving some other people that couldn't attend during the middle of the day last week an opportunity. But I am going to share with you what I consider the largest big divergence, and Don already showed you some of those divergences. The largest big divergence that we've seen in about 19 months. So a 19-month move, a 19-month change in the markets. And it's set up for even bigger. It's this confluence of barriers, a confluence of divergences and changes in the market and mass really shifts and what would you call it? The macro fundamentals of the world global economy. And we're going to talk a little bit about those. And tomorrow morning, we're also going to do some of it with the live TheoTrade Live in the morning. And so, all of those are things that we can look at and talk about as well. But I think you're here mainly because we have over the last, just year to date, this is our performance. Year to date, we've been tracking a portfolio. We beat the market by 100%. Now, when I say beat the market by 100%, we've done what they've done, double. And so when the market did 12%, we did 24. We were up higher than 20 some percent at one point, and we're currently at about 18% up year to date. And so the year to date move, the year to date climb that we're seeing in here is based off of not super active trading. We're talking about being slow, consistent, looking at this once a week. And when we go through this, we're going to show you probably twice a week adjustments, but this would take you maybe a half hour to an hour on the top end of things. And so when we look at this, we kind of just tore up the old rules of retirement planning. I mean, think about it for all those of you who are watching today. What are the rules they've told you as far as retirement planning and investing? I mean, I already tell you what my brother's been told. My brother approaches me on these things all the time. He's 5 years older than me, and he told me just last Sunday, we all converged on my parents' home, and he was saying, I just can't seem to know what to do, so I'm just going to buy, and I'm just going to methodically buy and put it into a fund and leave it alone. And that's a lot of times what we're told to do, right? Buy and hold. Exactly, Michael. Buy and hold, and just every time, just methodically, time-based, put money in the market and let it sit there. But the problem is that means you're going to be trying to follow the market as a broad market, and that's it. But there's more problems with that still to come. So we started with something new. No one else is talking about it. I have not seen anyone really take this approach. And we did this last year, and then I reset everything in January to do this once a week on Friday to perform like this. So once a week on Friday, and I did not touch or trade anything that wasn't live in one of our classes. And so that's what we're going to do for you here as well. Everything is going to be seen and followed. But then today's presentation, we're also going to talk about this great deep currents divergence of 2024. We didn't have one, or like I said, since 2022, October of 2022, and I'm going to show you what that looks like going back into that time frame. So this great divergence, we're going to get into the details there. I'm going to show you these things. I will answer your questions, so thank you for putting those in the questions. I will come back and answer those as we go. But here's the thing that I'm worried about, and maybe you're not. I want you to think back to these timeframes and tell me how you felt at the moment. If we're talking about in the 80s, when we saw the big market crash in the 80s, or the mid 90s when we had the recession in the 90s, what about 2000? Were you part of the 2000.com? I owned a data center, so I felt it very directly. And so I was part of the .com world and saw everything crashing around me. How did you feel during the .com bubble burst? How did you feel in 2008, the Great Recession? Even the last, just 2020, when we had the 1 year plague, that massive sell-off, how did you feel? I don't know if you understand some of the things that happened because of these corrections. I always point out to my son, who is training to be a pilot, is that in 2008 and 2009, when we had the Great Recession, pilots didn't retire, which means all the new pilots coming up through couldn't get the jobs. And so that's the reason why we have this massive supply issue of pilots. And so they're hiring everybody, and it's pushing great. It's a great time for my son to be chasing that down. But how did you feel? How did you feel when you're looking at these markets and you saw those corrections? I also know that they did a lot of surveys and talked to a lot of people in 2008. There are a lot of people that had thought that, well, I can't retire. I either have to keep going with my job or I have to go find a new job. There were people that went from top tech executives to greeters at Walmart. And so when you're looking at this, how did you feel? How did you feel when these corrections occurred? Because when these corrections, when these divergences take place, when these movements take place, there's usually warnings. And the fact is, when those crashes happened, when the 80s happened, when the 90s happened, when 2000 happened, when 2008 happened, when 2020 happened, money did not disappear. It moved. It moved from one spot to the next. And so while we're wondering, I can't retire, I can't retire, I can't retire, I can't retire, and when we're concerned about that, we need to remember that the money just moved. And as far as investing and retiring, the game has changed, and it is different as what we're seeing here with the old days of Lou Gehrig and Babe Ruth versus, current baseball. It is that dramatic. And you go back to what the game originally was when it comes to retirement. Yeah, 90% loss in the dot-com bubble, 67% loss during the 2008 Great Recession. If you were just sitting there, the money didn't disappear. It moved. It really did move. In fact, that's the only reason why, what's his name? I can't remember his name. The Mavericks owner, the billionaire. Anyway, he made his money because broadcast. Mark Cuban, thank you. See, Don's always lurking. Who's that voice? Mark Cuban only made money because he knew how money moved. And back then, he just knew that it was the bubble. He knew that it's time to move. He diverged. He changed his strategy, and he changed where the money moved. So back then, or even now, if you go with an advisor, unfortunately, your money is tied up. If you don't believe me, try to move your money quickly. Try to get your money tomorrow. If you're sitting with an advisor, unfortunately, your money's tied up. Your advisor, unfortunately, as well, are self-serving. Even if they have that fiduciary responsibility, they oftentimes are self-serving. There's sucker fees. You're a prisoner to the S&P because, like I said, buy and hold. What happens is they move your money in and put it into the spot and leave it there, and they leave it very passive. And I'm telling you this from a personal experience. I was recruited by Payne Weber, and Payne Weber had me sitting at my little desk, and they pulled all of us into a meeting. And in that meeting, they told us flat out, he said, stop trading your clients' accounts. Put them into one of our Fidelity funds, leave it there, and get back on the phone to get more money. That's all they cared about. They did not want us managing it. They did not want us adjusting to the client's needs. They did not want us focusing on anything other than getting more money through the door, putting it into a Fidelity fund, and leaving it alone. That was it. And they were all but yelling at everybody to do that. Now, we don't have to succumb to that kind of thing. And by the way, when I say prisoner to the S&P, it's actually prisoner to the S&P minus those fees. So when you say you want to buy and hold, if you're going with that, if you're not adapting, if you don't see where the money is moving, not only are you subject to that 67% correction in 2008, that 90% correction of the dot-com world bubble burst, at least in the tech sector, but you're also really underperforming the S&P because you're going to get the S&P results minus their fees. And I actually got an email from last time when we did this last presentation, and I was told flat out that their financial advisor told them you can expect to get 5% a year. That was after their fees. But if you're self-directed, you have full freedom. You want to move your money, move your money. If you want to change where it's at, change where it's at. If you want to invest in something else, do it. Your interests are first and your desires are first. Minimum fees because you can trade in ETFs, you can trade in stocks. Some of those ETFs have zero commissions, and you can profit in all types of markets, up, down, sideways, and you can be as active or conservative in any approach you look at. And Michael's asking whether you need to be a margin account or not. The list that we've shared, the watch list, I try to give alternatives to everything we do. So if I'm looking at crude futures, if I'm looking at gold futures, if I'm looking at a specific ETF, if I'm looking to go short, we will always try to have an inverse ETF so you can buy it and go long. We always try to have option strategies or stock strategies or future strategies so that you can adjust it to your needs and what your IRA allows. But we'll talk about that in a minute. This is why you're here. I want to be able to show you, and I'm going to give you some guide rails right here, how to outperform the market with less risk, how to build your portfolio. And we're going to start building that portfolio on day one, which means this coming Tuesday. We will start looking for trades. We'll start building it out. And we're going to start with a $100,000 demo account and portfolio as something that you can follow. And then we're also going to track it in the spreadsheet so you can have at all times know what positions I'm in and what we're watching. We're going to show you how to execute correct asset allocations. Now, knowing which investments are the strongest to generate the solid return, but that can also mean which ones are the weakest so that we can actually generate the solid return. We're going to watch where the money flows. We're going to identify and avoid the 4 biggest threats to your retirement. And we're going to hopefully make sure that you feel you have control, but we're going to give you the ability to take control of your financial future. That's why you're here. That's what we're here to do today. So the thing is, big growth isn't exciting, but consistent growth with no drawdowns wins over time. We can say, oh, it's so exciting to make 20%. Oh, I bought into NVIDIA. I bought into Bitcoin, right? And we see people chasing that down and they run in, they buy Bitcoin and they think this is the exciting thing because I made 25, I made 80% in 3 months. And then how do they feel? And maybe you, how did you feel if you invested in a Bitcoin and NVIDIA or GameStop, for heaven's sakes, and you bought into it and lost everything that you gained and even went negative? Steady growth with no pullbacks is always going to win. And the way we do that is we pay attention to the currents, the deep currents that are in this market. We're going to be watching where the money is moving. We want to see where the money is moving. Money is like matter. And certainly it's created by the Fed, but reality is it's never destroyed. It moves. It moves from one place to the next. When the equity sold off, it didn't disappear. It moved. Some of it moved out of your account somewhere, but it moved somewhere. And so the thing is, we want to make sure that we know that we cannot fight the flow. We cannot fight the river. And I asked this last time, and I know there's a lot of people here that are new that didn't join us last time. So as I'm looking at this, have you ever tried to swim upstream or even just across a fast flowing river? You may think that you're a really good swimmer. I'm a really good swimmer. I've swam competitively in high school. I swam professionally in high school. I swam competitively in high school. I still swim today. I try to swim, a mile multiple times a week. And so I'm a decent swimmer, but I know that I can't beat the river. You can't fight the flow. You may think you're even better than me. You're the Michael Phelps of the trading world, and that you can fight the river. And you think, hey, I'm doing really well. Look, I'm going upstream. I am the mighty salmon. I am the steelhead. And then what happens is there's other risks, not just the bears in the market when you're trying to be bullish, but there's other risks in going against the market when you can't see that are deep in those deep currents. There's hidden rocks. There's eddies. There's undercurrents or undertows. And there's leeches. Leeches that are going to fight you and drain you or burn you out while you try to swim against the flow. But the safest way to get in that river is to go with the flow. Now, this is just a picture. This is certainly not me, but I have done this. I have actually gone river rafting on the Salmon River, an amazing experience. And I've canoed and rafted in other places as well. But you'll notice it's not just about getting in a river and going. It's having a guide. You want to have a guide. You want to have the safety equipment, helmets, life vests. You want to be able to know how to navigate, which side of the rocks to go on, where the dangers are. And that's what the guide's job is. The guide is barking out orders and saying, do this, do this, do this, so that you can navigate this while going with the flow in a safe fashion. And if something happens, you're protected. And that's what we do. That's what we try to do. Okay. And that's done by buying the strong and selling the weak. Now, if you look at this chart, which one of these would you want to be invested in? This is a chart from the last 3 years. Which one of these would you like to be invested in? Which one would you choose? Which one would you choose? You like that top line? Do you like the middle line? Because what you're seeing here is this is the S&P 500. This up here is utilities. This down here And when we're looking at that, that's bonds. And so knowing where we want to be and where we want to be when we want to be there, I don't even want to pick the top one. I want to sell the bottom one. I want to sell the bonds. And reality is the S&P 500 in that 3-year time period, you see it peaked out at about 45%. So your best case is you could have got 15% a year. If you held it, buy and hold strategy, like your investor probably told you, you're going to be back here and you're going to be about 26%, 27%. We'll give you the benefit of the doubt. That means you're at 9% a year. And that's pretty standard without fees. That's 9% a year. And if you would have timed this perfectly, you could have got 156%. If you got out over here, you'd be at 108. So if we're at 108 over here on the left-hand side, that ends up being that every year you could have got 39%. 39% average. And if you did it right, you shorted the bonds that were down here in the 30s. We'll just put it at 24% here. By shorting or going bearish here and going long here, using the short bonds to pay for the long position up here, then what you could have done and benefited from on that move is the differential between the two. So now instead of looking at this and saying, I want to make 8% a year here, or 9% a year here, or 39%, we could have done this and traded this up for 47% annually. That's really what we're talking about. And I'm not going off the extremes. I'm just going off of the end of that 3-year time period. If we would have timed the extremes and known that we were peaking out and time to take profit, then we would have done even better. The thing is, the rising tide lifts all boats. We've heard that saying before. The rising tide lifts all boats. But there's more to it than that. The rising tide lifts all the boats, but the moon is what's causing the tides to change. The moon is what's causing the water to lift. What about the boats that are anchored and tied to the ocean floor? What about the boats that have holes in them? Okay, there's things that are trying to influence this and move the market, but at the same time, 70% of the stocks go up when the tide rises or the market's going up. 90% go down when the market crashes. But again, the market doesn't just crash. It's not a straight line crash. What happens is money moves. When the market is crashing, we're talking about equities. Now think about this for just a minute. Again, money doesn't get destroyed, it moves. So if you're in stocks and people start selling stocks, what are they doing? What is really happening behind the scenes? When you sold your stocks, where did your money go? Yes, thank you, Clark. It was commodities. I'm currently in utilities, so I apologize. That top line was commodities. Thank you, Clark. The utility is what we're in currently, and that's what I did the video on. So my brain was telling me utilities, but it is commodity. That was a commodity chart. Thank you. Yeah, so sometimes, Bo, they rotate, right? They go from stocks to other stocks. But if you are looking for safety, they oftentimes rotate into bonds or they rotate into cash. When you sell your stocks, if you just trigger a stop loss, if you are exiting the position, then what happens is you exit the position and go into dollars. That is a long US dollar position if your account is in the US. If you're in Europe, it's in euros. If you're in the UK, it's in pounds. If you're in Japan, it's in yen. But the fact is, when you sell a position into cash, that is a long cash position. It's an unleveraged long cash position. But usually when we're afraid, we either move into cash or we move into bonds. And that bonds is treated as a risk-free premium or a return on a risk-free premium. And so money just moves. And every time you've bought stocks, every time you've contributed to your 401k, your IRA, what did you do? You said, I have dollars and I'm going to sell those dollars to the market in return for stocks. Money is not destroyed, it's moved. That's all that's going on. So what we're doing is we're watching for where the money is going to move next. So where does the money move? Well, it moves from sectors and ETFs and individual stocks, and it moves from there into the dollar. It moves into euros, money markets. Money market's a cash position. Cash in your trading account is a cash position. And then it might move out of currencies into that long-term government, corporate bonds. It might move into gold as we're fearful of inflation. It moves into oil or copper if there's a growth opportunity. Agriculture price, it moves there when we see that we're a little concerned, but we might see that there's a bottom in agriculture prices. And we know, like consumer staples, we still have a tendency to want to eat, right? I want to eat. So I bet you agriculture prices won't fall anymore. So as we do those, money is just moving. That's all that's going on. There's nothing magic to it. It's just simply identifying it, seeing where it's going to go. There are ways to read the deep currents or movement of money to outperform the market. If we know where the deep currents are, if we know where that tranche of money, trillions of dollars are moving, then we should know which ones are strong and therefore to buy, and which ones are weak and which ones to sell. You can even know that, the professor, when he's talking about things, he's saying they keep buying the strongest and they keep selling the weakest. Exactly. Until those trends are over, that's going to keep happening. Buy the strong, sell the weak, buy the strong, sell the weak. And we're going to get the differential between those two. That's what we're looking for. Now I'm going to show you some of those currents and the correlated current movements and these moves here. Now I did, I got these up here from a different time period, but you'll see these are the same as you go forward. The 20-year treasury yield has a tendency to be positively correlated to commodity prices. And as we're looking at this, therefore commodities in the 30-year treasury prices are inverse because yields and prices are generally inverse. As you're looking at commodities versus the commodity treasury price ratio. Now that's a lot of words, but the comparison between commodities and commodities treasury price ratio, this is one of the best indicators of true inflation, because what you're doing is you're comparing commodities and the cost of things versus that risk-free premium of government bonds or government notes. And so the inflation is when the prices are going higher faster than bonds. And as we're looking at this, we see the deflation through there and we see that pulling back. So trend trader, we will start building it from scratch starting Tuesday. But there will be days that we get 2, 3, 4 positions. There will be days that we have just an adjustment position, meaning days or weeks. As we're looking, we'll adjust positions and sell premium against it, or collect more premium as we're selling calls against the long stock position, or selling puts to get into positions. So I think it's reckless to just simply throw everything at the wall when we're identifying where the movements are going and where the cash is going to be, and whether it's going to move into bonds, equities, commodities, or back into cash, and whether we're going to take a leverage position in the cash or not. So it's not going to be all at once, but we are going to start with on Tuesday. We're going to start building these positions. So bonds and equities have a tendency to be inverse in the short term and correlated together in the long term. So what oftentimes happens in the long term, bonds and equities kind of look like a let's call it a double helix. Right? It's the DNA of the markets. So they generally in the shorter time frame move against each other, but in the long term they move together. And do you know what that slope is? The difference between that, called the moving linear regression slope of bonds and equities, that, my friends, is also a good indication of inflation, or the purchasing power of the dollar diminishing. And so those are all things that we pay attention to as we're watching these moves. So as we're watching these moves, we're going to pay attention to that short term versus long term. Here's the long term and the short term. Obviously, the US dollar and commodities have a tendency to be inverse and go opposite of each other. They don't, if the dollar's purchasing power is getting weaker, then commodity prices are costing us more. If commodity prices are getting stronger, the dollar is usually less. But when the dollar picks up and starts getting stronger, commodity prices come down, and that is a disinflationary market. And I'll answer some of these questions, like I said, as we go along. So I'm not ignoring you. I'll get to as many of these questions as we can at the end. Okay, so this is just a quick table. Now, and I was told that you didn't like some of the, someone said, as a mathematician, I didn't like seeing the negative and positive not match up the right way. It's just that treasury yields and treasury bonds, or treasury yields and bonds and notes, have an inverse correlation in the short term when things are adjusted, and in the long term, it plays out of the bigger picture. But in the short term, if treasury yields and commodities are climbing, that means growth and inflation, generally speaking. So as we're looking at those moves, these are some of the correlations, or the deep currents that we look at: positive deep currents and negative deep currents. What we're going to look at is when the traditionally positive is now negative, when they're moving with each other, when they're normally moving against each other, when the currents are usually colliding and making that deep problem in the markets. That's what we're looking for, when history or the normal tendency of the markets to have these negative or positive correlations are broken, when that divergence occurs. So I'm looking at a macro view, and as Don said, you can even do that in the individual equities, but I'm even looking at a bigger view. So as we look at this big deep divergence of 2024, I want to show you kind of what this is looking at like. So when we see these correlations of breakouts, I like to look at these main four things. So the current divergences, we're looking at the equity market, and we can leave that the S&P 500. I like looking at the ZN, so it's the 10-year treasury notes. But as we're looking at that, and we can use the 30-year bonds, but we're looking at the notes or the government fixed income. And we look at gold prices. Sometimes we use DBC, Deutsche Bank's commodity fund, or we use copper. Depends on if we're looking for inflation or growth. And then we're going to use the dollar index. The dollar index is the dollar versus a basket of currencies. Now, these ones you can see is ES, ZN, GC, and DXY. Those are 3 bonds and an index, and you really can't trade that index. This is what we're going to use to help us identify the flow of capital. Where is the money moving? And when we see it break, we look for these to diverge. And the last major divergence, like I said, was 2022, when gold prices and equities dropped down, but we saw them going counter to what we would normally expect with the dollar and with bonds. And so when they diverged from each other in about a 4-week time period, that set us up for one of the biggest gains in equities, one of the biggest gains in gold. And at that time, bonds flatlined and reset, but the dollar peaked out and reversed. Now, the dollar fell about 12%. Equities rallied about 30%, and gold, as you can see here, went from 1,600 to about 2,000, and that's about a 25% move. So when we're looking at these moves, that was in a matter of a quarter. So when they diverged, they set us up, well, that's about 2 quarters. We'll call it 2 quarters. So 6 months. So 6 months, you had an opportunity to make 30%, 25% to hedge against the bonds. And when the dollar moves 12%, just with the slightest leverage that is available in the currency market or the futures market or even FXE and ETF, generally speaking, when we see the dollar move, we get a 2.5 times equivalent move in equity indexes and a 5 times move in individual equities during the same time frame. So equity indexes, we would expect to move 30%. Guess what? Dead on. And individual stocks went as high as 30% during that same time frame. So as we're looking at these moves, we're seeing the changes and the shifts. We had some stocks in equities and commodities, or sorry, equities like in the tech sector do the 60% move that we saw in there as well. So as we're looking at this, this is kind of what we're setting up now. We're setting up the same divergence. And let me show you what that looks like when it comes down to this chart. I've got this one pulled up, so I will show you how we would approach this. And this is part of the reason why we wanted to add this, is because this was the setup, and I commented that we're at this key inflection point. The dollar had found support, broke out, pulled back quite aggressively, and found the support, found the support, found the support. And yesterday we saw a sell-off, an attempt to push back down, but notice the dollar is still winning. The dollar is still winning despite some of the news we're going to talk about tomorrow at the Theo Trade Live session in the morning. The dollar is still king. The dollar is holding above that support level on that long time frame. It's holding at that support level on the short time frame. And as we're looking at this bounce up through here, if the dollar is going to go from 105 to 106.50, it's not a big move, but we can expect equities to peak out here. If the dollar is going to gain in purchasing power, then this could begin the pullback of 2.5%. Now we rallied, we pushed up here, and as you can see, today was a flat day. Almost that. In fact, the ES futures, the S&P futures, played out perfectly flat. That is a warning. The dollar gained. Equities tried to advance after Fed Day and could not do it. That is a doji. And we're seeing it on the weekly charts. We're seeing it on the daily charts. We're seeing the setup. Gold has pulled back to support. If the dollar is gaining stronger, then we do not need to hedge inflation, then gold could break through the low. I commented today in our long-term portfolio that I do on Fridays that this is going to set us up for closing our gold position and seeing a new movement of money. Bonds went higher. Bonds went higher, and the Fed left rates high and said they're going to leave them high, and there's no intention of cutting rates. And bonds demand went higher. So this is a flow of capital from overseas into U.S. bonds and treasuries, and not into equities after the Fed. This is not fear of inflation because we kept rates high. And so we're still fighting inflation and the dollar wins and gold pulls back. This big divergence is setting up for what could be the next 30% move or more in equities. And unfortunately, it could be to the downside. And if we're not ready for that, if we're not aware that the dollar's strength and bonds rallying have a tendency to see equities reverse, and after we have that diverge from each other, after a weekly, multiple week divergence, we might not be ready for the 30% correction. And I commented just the other day, I expect the market to move up before it moves down. And we did see that in recovery and saw the NASDAQ pushing up. So we're going to time this. But what it means, like John J. Murphy said, is what this means for us as traders and investors. It's no longer possible to study any financial market in isolation. You cannot just say, I'm studying equities. You can't say, certainly can't say, I'm just studying NVIDIA. You cannot do that. There's no such thing. You cannot study in isolation. Money moves. And by the way, when we look at that big divergence, one of my favorite quotes of all time, because it applies to about everything, is from Mark Twain. He says, history never repeats itself, but it does often rhyme. I hear a rhyme coming. Do you hear the music? Do you hear the rhymes? That's what we need to pay attention to. To hedge out risk, we're going to rotate into strong currents and out of weak ones, into strong assets and out of weak ones. We're going to actually not only rotate out of weak ones or weakening ones, we're going to take bearish positions or a leverage position against the weak ones and into the strong. That's how we're going to do it. So again, we're looking at that market. And if this one is a little bit confusing, we'll show you that you can stack it this way and watch for these to diverge. When they should be rising together, why are they not rising together? So when we're seeing this go up and this go down, that's a divergence between bonds and the US dollar that shouldn't be there. When equities are rising and pulling back and then we rise and pull back, well, those are in agreement, that in short term on gold and equities. But we're going to look at those and we're going to determine which ones do we want to buy. Now I watch these major macro views, and I did tell you commodities. I told you wrong and said utilities, but you're right, it was commodities. And so it's commodities versus bonds. And that's an inflation play. And we saw it, and we saw it in the charts, and we saw the movement of the money. And so we know we want to be long commodities, and we want to be short bonds when this was going on. But we've diverged, and now bonds are breaking out, commodities are at support and about to break down. This pattern could be over. And I'm not a big follower of the cyclical behavior alone, even with commodities, like some are. You've got to pay attention to all aspects. You can't just be a commodity trader. You can't be just an equity trader. You can't be just a currency trader. They're all connected. And so as we're looking at this, you can look at this and say, well, but look how well the S&P has done. How many of you have heard, and I'm very serious about this, how many of you have heard that if you just leave it in the equity market, then you can expect an 8 to 10% consistently for all your life? And they show you even back before the Great Depression, in the 1920s, that if you would have just bought and held, you would average 8 to 10% outperforming inflation, blah, 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 blah. Because the reality is they're looking at this and driving in the rearview mirror. In the business world, the rearview mirror is always the clearer than the windshield. And it's easy to look back and say, that's what I should have done. We have to see it happening as the currents diverge, as the currents collide. We need to see where things are broken and where they're setting up. We need to see the money moving. And so when when equities stop climbing, it doesn't mean we're bailing and going short right now. It means we're saying we're watching and we're getting ready to move into these other instruments. We're getting ready to move out of one into the other. Now we're going to use moving averages. Yeah, hindsight's wonderful. Exactly. That's a lot easier to say than done. Well, you shouldn't have driven on the ice. That's hindsight, right? What we're looking for is we're looking for the ability to see money move. Well, I appreciate that, Riley. If you put me in the category with Don and Jeff Bishop, I will take that as a compliment. So thank you so much. Yeah, 2001 tank, 2008 tank, 2020 tank, 2016. A lot of people don't even know, like Don is talking about, 2015 and 16, we pulled back 30-some% in the Russell and no one talks about it. We're not in a 20-year bull cycle. We had a correction in 2016. 2015 really for the Russell. And so guess what? We're already in the 7-year cycle as far as a normal equity move, but it's not precise. We have to see it happening. We have to see it developing. Now, I've shared this before, and I've had people question my math. I'm going to show you the math and the reason why I use this. The NASDAQ, for an example, NASDAQ was trending up until it dropped from the strongest position to third position when I do my comparison chart that I just showed you. And the dollar's moving average crossed up. We're looking for these long-term moving average crosses. We're going to also use a tricks indicator to time some option trades. But the dollar crossed up and gained 2%, remaining in the top 2 performing sectors. Now you say 2%, well, that doesn't sound very good. You really only leaving your money in cash gives you 2%. Any instrument that is traded that it represents the dollar index has leverage. The currency market, like the 6E or the euro, is 50 to 1. So just seeing that movement and participating in that 2% move, your leverage based on your margin, if you're trading a futures or a spot currency market, you get 50 to 1. So we're talking about 100% gain in that short of a time period. But if we're going to use FXE, which is an ETF, we can still get 10 times in that move. Okay. And when we're doing positions, we're going to sell calls when it's appropriately against long positions. We're going to sell puts to get us in long positions. We are going to buy long puts. We're going to buy long calls. And for those of you that have IRAs that can't do that, again, we can always give you alternatives to every one of these. So even though we'll use GC, gold's futures, to determine what we're going to do, GLD's crossed up on September 18th, or crossed down, excuse me, and then we saw prices drop 6%. That sharp reversal. If we counteracted these, if we sold bonds to fund positions in the NASDAQ and the dollar, if we saw those positions, or the NASDAQ fell there as well, then when we're buying strong and selling weak and moving the money around, the return would have given you about 20 to 22% with the proper allocation. Now compare that during the exact same time frame of buy and hold. The S&P would have made you 1%. 1%. Great. Buy and hold, 1%. How did that work with inflation? Do you think inflation is dead? Is there any chance that inflation is dead? Right? Yeah, and 2015 was a tough year to trade, but we can see where the money moves. And that's what we're here to do. Okay. So as we're watching these things, we're watching for the money to move. We're watching for things to change. The biggest secret is you don't need to be perfect on this. So here I am talking about how the money moves. If you're looking at this and I'm watching the river flow and I see the new river is coming through here and I see the river shift. If I am trying to put my boat in the water, do I have to time it to a specific part of the water, or do I just need to get the boat into the current? We don't need to do this on a 1-minute chart. What I've done with this, and I've built this for this opportunity and for that, the big divergence that we're seeing, is that we're looking for just the strongest current. Watch that money move. Watch that currency flow from one thing to the next, from equities to bonds, etc. And our goal is not, we don't have to time it to the minute. We don't even have to time it to the day. We're going to adjust and tweak these once a week in most cases, sometimes twice a week. But that's not a new trade every day. It's not even a new trade every week. Sometimes it's 2 trades a week. Sometimes it's 4 trades a week. Sometimes it's just an adjustment. You do not have to be perfect in moving that money. It's about timing it and getting into the current. And so those portfolios that I've already shown you the results that we've done, those results are based off Friday. That's it. It's not a drip methodology. It's not a buy and hold. It's not dollar cost averaging. It's saying, what's happened in this last week? What's moved? What's changed? What hasn't? Do I need to adjust anything? Do I need to protect things? Every trade is going to be risk managed. Every trade is going to be risk defined. Every trade is going to be going with the flow of the current and the flow of the markets. And so when we see those diverge and we see those set up, we're now getting ready to change that allocation. Perfect timing. I couldn't have asked for it to be a better timing as we start the class next Tuesday. That dollar has established its bounce. We've moved higher off that low. We're seeing it and we're ready. The part of that big secret is easier to reach your retirement goals by reducing portfolio volatility. You can make 12% a year with a 2% drawdown and be consistent with that 12% with no more than a 2% drawdown ever. And you will outperform a market that does 20% a year, but occasionally has a 50 to 60% drawdown. If you were part of the 2008 drawdown, how long did it take you to get that money back? If you're part of the 2000 drawdown, how long did it take for you to get that money back? The reality is that was a lost decade. That was a lost more than a decade. That's what happened. We created this weird looking super channel, but the reality is we fell roughly the same percentage in 2000 and in 2008. And if you were in the buy and hold scenario, it took you 8 years and about 11 years to recover. Now, you may be 22 years away from retirement, and you might say, I'll be fine. But why? Why would you subject yourself to a 50 to 60% drawdown? In 2007 and 2009, this method would have been long gold and commodities, short equities, and the US dollar. They would not have lost. You would not have experienced that 67% drawdown, but you'd also gained 22% during those same 2 years. So while everybody else is experiencing losing 2/3 of their account and taking 11 years to recover, this methodology of seeing where the money is moved would have gained you 22% and 22%. Instead of taking 7 years to recover, we grew. That's how this works. And I've gone back to multiple changes, multiple movements in the market. And the nice thing is, because we use a very systematic approach to know when to get in and when to get out, because we're watching the major shifts and changes of the money flow, we can go back and see how it performed in any different time period. Last year, I started with the live account where we're only doing it once a week, not back tested, just trading it live, practicing it through. And we beat the market by about 50% last year. And again, this year we've been up 100%. We're actually only up about 83% right now with that spike in the equities. They almost tried to close that gap, but we're still up about 80-some% instead of 100% in year to date today. But we still could participate in that bull run. And if you don't know the secret, my question for you is, are you going to be ready for retirement? Do you have a plan? Do you have a plan how to avoid the next drawdown? Well, maybe back it up. Do you think that we're going to see a 2000 type crash, a 2008 type crash, a 94 type crash, or 92 type crash, an 86, 84? Do you think we're not going to have one of those crashes before you retire or while you're retired? You have these plans about this is how the money works. And maybe you're saying, yeah, I'm fine. But even if it crashes, I'll still be fine. Well, I'd hate for you to lose out on the trips, the vacations, traveling to see your kids, your grandkids. I would hate for you to avoid all the cool things that you had planned in your retirement. The question is, do you think that you can avoid the next major drawdown? Did you experience the last one or the one before that or all of them? Because if you don't, then you are going to be part of that. So here's the thing. Alexander Elder, great book writer. He's written books. He's a psychologist that turned trader. And he said, beginners focus on analysis, but professionals operate in a three-dimensional space. They're aware of their trading psychology, their own feelings, and mass psychology of the market. We have to be aware that money moves, and that trading psychology and the mass psychology of the market and our own feelings and how we behave, our behavioral economics, impact all of this. And if we understand that, we can hopefully be ready to avoid the 3 big threats and really 5 total threats of the markets. So 4 biggest threats: outliving your income, medical expenses that eat up your retirement, downturns in the market means that you can't recover, inflation that means that everything costs more, and that you don't have an adaptive, personalized plan to retire comfortably. Those are the concerns. And some of you have 8% mortgages. Yeah, and Blake says, I'm retired 7 years now. Are you ready to protect that account? If you're retired and you got your retirement funds and you're there, or are you saying, well, I'll just live on Social Security if the market turns down 67% or 90% if I'm in the tech sector only? Right? Are you ready for that? Are you ready for the next thing? Are you ready for the next move? We want you to avoid that and let those things turn. So, and we'll go through the course and what the course is. This is the course. Now, I've been doing this 24 years. Okay, I've been trading for 24 years and teaching classes. Like I said, I've been a CTA, a hedge fund manager. I've created dozens and dozens of courses. I was, when I did the live mega events. I was the only one that did new content every year for 11 years and multiple things. So as we're looking at this, this is kind of what we've done. I've never done this before. I've never offered this type of a course. So in this course, we've done more than we've done before because it is a big picture view. We're going to time our trades, but we're also going to want to make sure that we know how to manage it over a long time period. So the course is 12 weeks. So that's the first thing. So Sandra, is a 12-week course. And every week on Tuesdays, we're going to meet. I'm going to show you how we're doing this. The old methodology of, we're going to teach you to fish, not just give you fish. I am going to give you fish too. We're going to give you fish, but teach you how we caught it and teach you how to catch it yourself. But the 12 weeks, we're going to go through the course, the material, how to do it, why we do it, and what we do. Okay. I'm going to show you the methodology so that you can apply it. And that way, after all said and done, you can do this ongoing, because I don't see any reason why money won't continue just moving from one thing to the next. Money's not going to be destroyed. It's going to move. It could be created, but it's not going to be destroyed. It's going to move. And so we're going to talk about the methodology. We're going to start with a $100,000 portfolio starting next Tuesday, this coming Tuesday, and we're going to start placing trades. So that means we're $100,000 unleveraged US dollars. That's what we're starting day one. But do we need to move it out of US dollars? Right now, the dollar's winning, so that's a good place to be. But we need to start moving it into other places so we can get the leverage, we can get the opportunity, we can define the risk, okay? And then every week, we're going to give you deep current alerts. We're going to let you know what we're doing. Are we adjusting? We're leaving it alone. We're adding new positions. So every week we're going to give you an alert and email saying this is the setup and this is the trade. This is where we're going to build. This is where we're going to close. This is what's expiring. And we're going to continue to give you those weekly deep current updates. And then we're going to do a monthly call for 12 months. For 12 months, we're going to do a monthly call where we're going to show you new updated positions, new shifts in the market, new macro view, minor driving it down, substitutions like we've talked about. If you're in certain accounts that don't let you do some of the strategies, we'll show you how to substitute and still play those in your accounts. And the watch list that we've got for you here, the watch list has 100 plus instruments on it, is what we're going to get to. And I've been putting in, from last time to this time, I've put in some of this alternative because I had a number of people saying, but what if I can't short? So I've been putting in a bunch of inverse in the macro market so you can see where those are at. And then obviously get email support. And Don, I know he pushed this a little bit last time. He said, Blake's going to respond to your emails. I had about 83 emails after the last one. And I expect more today. It's going to happen. But the nice thing here is we're going to give you a 90-day money-back guarantee. If you're not satisfied in the next 90 days, email support, and we're just going to give you a refund. There's no questions, no guarantee stipulations. We're not going to say, well, but do you like them, or do you not like them? It's none of that. There's no requirements. You just have to say, look, this isn't going to work for me. 90-day guarantee, I'm done. And others are going to say, wow, look what we've been able to do so far. Look how I've been able to distribute my money. Look how we're able to protect my retirement. But again, if you 90-day guarantee, no excuses, no questions, no commentary, just email us. We'll get that back to you. Okay, that's what we're going to do. And there's only 100 spots, and I don't even know how many of the 100 spots are available on the 90-day guarantee. Maybe Don can help us with that here in a minute. But the extra bonus, again, unlimited email mentoring. We figure the total retail value of this course is about $8,450 today. It's $19.95. And if you'll follow me, we're going to go to, you can type this in yourself, theotrade.com/DC. If you'll type that in, theotrade.com/DC, you'll see a number up there at the top. It's 623-244-5657. And this will give you some of the information as well, some of the things we just talked about in today's session. And again, I want you to know that you can jump into this, and it's not just jump into it and join me for the first session. Jump into it and join me for all the sessions. Isn't that kind of what it's at? 90 days. Don, you just popped onto my screen.
Yeah, I know. You go through a huge amount, even in the first 90 days. And it's one of the most important things to us at TheoTrade. By the way, you don't have to call us. You don't have to do a little dance, make a little love, get down tonight. There's a 90-day money back guarantee on it. And the one thing I always say is, look, I get it. Sometimes life gets in the way and so forth. We understand. It's okay. You don't have to tell us. You can just email us. There's a money back guarantee for 90 days. And we do that because we totally get it. This is not like a gym membership where you have to give blood to be able to get out of the membership. It's one of the most important things. By the way, the link is directly on the page above this video, and you can click directly for there. It's theotrade.com/D as in dog, C as in Charlie. And again, you can of course see the money back guarantee on there. Blake, as you actually scroll to the bottom of the page, the enrollment form in there. One critical thing inside of the enrollment form, put in an email address, okay? That is a valid email address, one you actually use, because when we're sending out, okay, what Blake is actually doing, the moves that Blake is doing, the archives, people always ask that question, is this archived? Every spoken word on TheoTrade is archived. Literally, we archived and have archived every single spoken word since we launched TheoTrade in 2016. I mean, we're talking petabytes of data that we've actually archived. So we can send you out, of course, links. We actually send you out, alerts and so forth through that particular email address. So it's fairly critical in there. And again, it's a single payment of $19.95. Also, the reason we have that 623 number up there, 623-244-5657. If anybody said, I needed a payment, it was actually down below too, Blake. But
Oh,
if anybody
sorry.
said, they wanted to know about anything in a payment, they're not comfortable paying this or that or the other one at the same time, it's okay. Just give them a call. I mean, that's what that concierge team is specifically there for. There's also, we always come across individuals that are still not that comfortable, entering information in online. It's fine. You can give us a call, 623-244-5657. So Blake, back to the package and everything that's actually included in here. As you actually jump back over to your slides here, one of the aspects that's incredibly important. So it's 12-week mastermind. That 12-week mastermind, people have been asking, how long are the sessions? Supposed to be an hour. I'd have never known Blake to go less than about 90 minutes
I
on
try
any one of
about
the
2 hours.
sessions.
Yeah.
Everything is archived. So I want to reiterate that again. Everything is archived because that's important. And this, no pressure, but it starts June 18th. It's no pressure, but it starts June 18th at 3 p.m. And he's going to start with the next question that comes up constantly that I've answered a few times in here, and then I'm going to let Blake have added some questions in here. But the $100,000 portfolio. Look, no uncertain terms. You do not have to have 100,000. Okay, everything that Blake is going to do can be done inside of an IRA. So there's always concern about that. We have brokerage firms that we do work with, several with very close relationships with. So you don't have to worry about people like, well, I'm not approved to do this or not approved. That's okay. That's okay. So the amount of capital that you start with, somebody asked about, $15,000. It's fine. This doesn't have to be a significant portfolio. What you'll see and what Blake will actually discuss is that there are great trade substitutions. And the example is instead of buying the spiders, it's a 500 and something dollar product these days. I have to choke when I say spiders are 500, but it's like a $500 product these days. So there's a great substitution. He can talk about a spread and put you into a spread which can have a few $100s at risk instead of tens of thousands tied up. So that's critically important. Okay. We are actually using a portfolio though of the $100,000 and tracking and managing from there. So that's critically important. The other aspect that comes up is, the monthly calls. Somebody was asking a moment ago, how long is this program? It's a year. Okay. It's a full year. And the monthly coaching calls is going through, I love the quote that he had up there from Warren Buffett. I'm not a huge Buffett fan, but I actually love that quote because I always talk about markets. Markets are always like driving a car at 100 miles an hour, looking through the rear view mirror, right? Because you never see what's coming. And the cool thing is in this, those calls, on a month to month basis are going to be what Blake has actually done. Okay. What executions, that is trades and or positions he's currently carrying. Okay. And the trends and the currents, if you will, of what, okay, is forthcoming. And that's, I mean, there's critical aspects, obviously, of what we term deep currents and those alerts from deep currents. So that's important. Obviously, those calls are quite critical moving forward. So as I said to you, though, everything is archived. Everything is archived in here. Um, somebody was said, any chance other brokerages, okay, new futures platforms and so forth. Yeah, we actually have an entire list. Since Charles Schwab bought TD Ameritrade, I'm very broker agnostic, and I'll give you the highs and lows of every major firm out there and have no qualms about doing so. And this firm is great for this, but they're terrible for this. Yeah, we can absolutely, take you through that, but don't let the brokerage firm ever stand in the way. Don't ever let a brokerage firm stand in the way of what you want to do with your capital. In an IRA, you can do anything you want now inside of an IRA. They changed the regulations back in 2020. Some of the firms have adhered to the new regulations, some of them have not. So, pretty critically important over there. Um, yeah, somebody was asking about the 90-day guarantee applicable for 3 years. Absolutely. Unequivocally, absolutely. Because as I said to you, the money back guarantee is for you to feel comfortable. Okay, of course. And it's again, it's one of the most important things to us here. We don't want anybody to ever feel, okay, that you're in some type of a program that, isn't per se for you. Or, in that first 90 days, you're like, I'm taking a little too much time. Honestly, this is probably more hands off, okay, than most of what we do at TheoTrade. I like to think of, what I do on a day-to-day basis is more very active trading, where what Blake is doing here, I would say is I construe it, Blake, as more of an investment, feel, an asset allocation. It's a little bit, more mellow, and that's good. When it comes to, investments, this is a good thing. Again, finding the deep currents and actually getting in that marketplace and allocating asset classes, it's critically important. All right. You know, Alvin was asking, will E-Trade work? So we've had a marketing relationship with them for years. I don't love it. I'm not going to lie to you. I don't love it, but we can kind of make do, to some degree. Again, we've got definitely our preferred, if you will, list out there. So, Blake, a few other questions that always come up, and I just want to hit these routinely. If you want to go back over to the page again, it's theotrade.com/D as in dog, C as in Charlie. But as you actually cruise back over to the page over here, some generalized questions before I get too specific in here. People always ask, what do you need to get started? And the truth is, you don't even need a laptop anymore. You got an internet connection, okay, a phone, maybe some type of a tablet. Doesn't have to be an iPhone, doesn't have to be an iPad or an expensive one. I mean, anything. You can now execute trades off of, an Android tablet, an iPhone, whatever it may be. And that's fine. It's totally viable. The point that I'm trying to make is we have everything you're going to need to be able to get started in here. And Blake is far more methodical in classes like this than I would be. I have certain expectations when I do classes. You're supposed to be here, okay? Blake's gonna take you from kind of A to B to C. My problem has always been, and this is going back to like early Thinkorswim days. I think A, B, Z, not A, B, C, D. And I think Blake's going to be a lot more methodical than I would in here. So the other thing people always ask is the membership. Do you auto renew? We don't. Okay. So like, look, you're signing up, you're getting, a full year of access to Blake. And please, I encourage you to torture Blake with questions and emails. And by the way, that's, it's longevity for Blake. You're keeping him here for longer and longer. Look, let's all be honest. We have nowhere else.
3 years.
We have nowhere else to go.
No one,
We have nowhere
no one
else
else
to go.
wants me.
Yeah. So I always tell the story, Blake. I always tell the story. After TD Ameritrade, I spent like it's almost 3 months just kind of not doing anything. I had to take off between TD Ameritrade and launching TheoTrade. I took off like 3 months, and my wife and I, hey, we were married only about like 5, 6 years. She's like, if you want to stay married, she's like, you need to you need to do something right now. Go up and start trading and do something. I'd go up every day and I would trade and start like yelling at the screen. She's like, it's a great idea. She's like, people might want to hear what you have to say when you're yelling at the screen. I'd just sit there by myself yelling at the screen. And we have a name for that now. It's called Theo Trade. And Blake was right along that. So we put a microphone in front of him as well. And that is Theo Trade. So it's funny because it really is. It was more truth to that than you could ever imagine. Some other generalized questions that come up. Okay. So again, Blake is totally accessible via email. I'll give you one caveat. All right. You got it. You send him an email, you'll receive a response within about 24 hours. And the reason I say that is there is only one Blake, but what we've actually done for this program and all the programs here is we actually stack out a team that understands concepts in here. So if Blake overflows, Brandon Chapman, myself, Jeff Bierman, we all actually hop on the email queues and help him out. So you'll receive a response within 24 hours. And if you want a response directly from Blake, you will absolutely unequivocally get one. That's so
There are just some
important.
days that I'm
I'll reiterate
do
this.
4 hours, and then I just you got to give me a second to catch up. But I will catch you every time. I will respond to every single email.
Yeah,
So
it's funny. On an average day, that's too not too far from me. I actually I don't sit in front of my computer and answer emails. I'm usually on my iPad. I answer a lot of emails every day. I have no problem doing it whatsoever because it keeps the head in the game. I've done that since early Thinkorswim days, TD Ameritrade days. People thought I was crazy when I was at TD Ameritrade. Like, there's 7 million clients, man. You can't answer all the emails. I'm like, I will damn well try, and I will. Um, Another question that came up is again about the IRAs. Everything that he's doing is applicable to the IRA. IRAs, as I said, they lifted the restrictions years ago, so that's important. We at TheoTrade can help you get approved for if you are going to trade options or any type of commodities. We can help you get approved for all of that at several major broker dealers. As many of you know, Thinkorswim is now Charles Schwab. It's a little more difficult to get through Schwab. There's a whole lot of red tape packed on top of them, but it's all right. Okay, it's all right over here. And again, look, get results, take action, and enroll for Theo Trade and Deep Currents now. So a few names, by the way, individuals that are enrolling, and we see you. It takes us anywhere from 5 to 7 minutes before I can actually see you enroll. But Patricia K from Florida, Shirley Q from Georgia, uh, Audrey U from Illinois. This is the first three names that I've seen actually populate through. I'm just letting you guys know we see you. You're enrolled, obviously. You receive the 90-day money back guarantee on that one, and that's critically important. I tell everybody, look, if you are enrolling and for some reason, okay, Blake, you're set up for this Tuesday, the 18th. Okay,
mhm.
how interesting too. You're set up for the 18th and the 19th were closed. It's the weirdest week. We have a week coming up in the markets. Check this out. Next week, it's a triple witching week, which is important, right? It's the expiration of June, and it's a big important week. And June 19th, equity markets are closed, but it's unusual that it's closed obviously right smack on a Wednesday in the middle of the week. It's not a long week and so forth, and it's a little bit of pressure on a lot of traders about how that's going to amount. So we'll see. Be interesting. Kind of be a fun week next week.
Yeah.
So it's a 4-day trading week with a pause in the middle of it. Which, by the way, almost all the week next week is a holiday here. I'm in the Virgin Islands. If there's one day off on any week, the whole week everything's shut down. My bank is closed for 4 days next week. 4 days, man. 4 days banking holiday next week. So it's a good time. It's a good time here in the Virgin Islands. All right, Blake. Anything specific that you wanted to address now in here?
I'm going to go back because at the beginning I saw a lot of people that said they missed the beginning. I do want to make it clear whether we're talking about you feel like you have some restrictions. I know we've had some professional investors sign up, so maybe the advisors are going to be doing what I'm doing, right? But reality is, every time that you have something that is restricted, if you can't take a specific type of position, we will do our best, one, like Don said, to either help you get approved for it or to give you substitutions. And I started adding to our watch list already to create substitutions. And so we'll continue to do that. We'll continue to adjust that so that it is as acceptable and acceptable to your IRA or your brokerage and accessible to you to be able to trade everything I do. And again, we'll start out with you seeing everything I do, but in the end, we want you to be comfortable saying, hey, I see this, and this is something I like, and we'll talk about those too. But yeah, we'll be giving you everything that you need. We'll be sending out the alerts via email, as Don just put in the chat as well, and I typed in the chat. And so you'll get everything that we set up sent out as an email as part of the class. You can also see it live because I will be setting up the trades during the class and then emailing it and then doing the monthly call to review what we did in the emails as we go out for the whole year.
Another question popped in here just a moment ago. It was actually from Alvin and said, it may take me a week to get the additional funds into the brokerage account. Will that be an issue? Absolutely not. As I was saying a moment ago, I think what Blake is doing is it's not like when I put on a trade and I execute something, it's like, okay, we are in, and I might be out like in a week. Like Blake, again, this is a little slower, a little bit more methodical. And ironically, it's sometimes a week later, you might even be able to get some better positioning. Nevertheless, okay, Blake's going to still start off everything here in deep currents relatively slow, and that's also critical that you understand that he's not going to hop in and okay, first day, welcome, let's do this and this and this and
fully
this.
allocated in 1 minute. Yeah.
As I said, it's A to B to C to D. Blake is much better, much more methodical than I might be at this particular, kind of juncture in there. Somebody else was actually asking about like E-Trade again. The answer for E-Trade is, and it's not a knock on them. Actually, one of my closest friends, and like you'll know who I'm talking about. It's none other than Mary Ryan. She runs most of E-Trade these days. So there was like a little core group that ran Thinkorswim, and it's like the brokerage mafia now, kind of like the PayPal mafia. One of my friends runs Robinhood. Another friend runs, obviously, part of Charles Schwab. Another friend, actually, he's the CEO of Tasty Trade. And another friend, she's the managing director of E-Trade. So, I mean, I even have friends over at Interactive Brokers. You name a major brokerage firm, and the core that kind of ran day-to-day ops over at Thinkorswim, it's them. They're running the entire, United States brokerage firms. In fact, brokerage firms all over the world right now. So I'm pretty comfortable. Like, I don't mind saying, like, look, yeah, you can do this with E-Trade. And I don't want to say, oh, they're naughty, but for better technology, for flexibility, for variability, you might want to select another broker. And that's just, my personal feeling. By the way, Elaine R from Oklahoma, just seeing your username come through right now. Fantastic. Anything else on the docket here, Blake, that you see specifically
No,
that kind of jumps out to you?
it's just, I just think that, as you're looking at this and, one of the comments was Tony's class and my class. And again, that's part of the reason why I say, join me next week. You have 90 days. And if you feel like it's going to stretch you again, mine's going to be slower. I would joke and say that, I drink high amounts of caffeine in the morning and I scalp futures. This is in the afternoon, once a week, twice a week, and it's uncaffeinated by the end of the day. It's slow and easy and consistent. So I do believe you can do both. And we are going to be very consistent. It's very rules based, and we're going to show you how we structure everything. And so I don't want that to be a hindrance to you. I'd rather you come check it out. Sign up, join me the first week, second week, third week, and you're going to say, hey, I can absolutely, not only can I manage this, but I'm already seeing the returns and what we're doing and allocation wise.
Yeah, and that's exactly why we do that money back guarantee. By the way, a few more names: Henry B from Connecticut, Bo S from Texas. Just seeing some of your registration data come through, and thank everybody for that. Yeah, excellent. I like that. The toss parachute package on the way out. So yeah, no doubt, no doubt. It's Charles Schwab. They're a little slower out there, but again, I've become very much like broker agnostic. Like, I'll trade with whoever lets me do, okay, whatever I want to do with my capital. And, you know, Schwab has some restrictions and a few other firms out there, including Tasty, that they're totally up and coming right now. And we'll see how it goes. Especially like technology, though, is of critical importance to me. So with that, I want to thank everybody for tuning in tonight, and obviously thank Blake for putting this presentation together here. If you ever need us, just hit us at support at theotrade.com. Obviously, for enrollment tonight, the link is actually found at the top of the screen. We actually have the link all over this screen. It is theotrade.com/D as in dog, C as in Charlie. Thank you guys very much for joining us tonight, and have a wonderful evening. Bye bye.